Welcome to the RAI International 2020 results webinar. I now hand over to Soraya Narfeldt, CEO, Lars Narfeldt, COO, and Andrew Bolter, CFO. Soraya, over to you.
Hello. The main purpose of today's course is to discuss our full year's earnings that we announced yesterday, and also to provide investors with a brief update on the events in Mozambique. You'll appreciate that this is an ongoing situation and we're very limited in what we can discuss and share. After this slide, Tamsin is obviously going to be moderating the Q&A, and we will hear from her at that time with your questions. The 2020 financial performance was quite strong. We had excellent growth in IFM and supply chain service revenues, and this offsets the slowdown in the construction revenue. We maintained a very good level of profitability despite the contraction in the revenue from the construction revenues being delayed. COVID is still a factor and is still affecting us because it's affecting our customers and it's impacting their travel into the locations that were operational. We'll talk about our customers and the business development later on in this deck, but for now we'd like to reaffirm the order book is approaching 200 million, which is excluding the Danakali announcement and excluding the Cherokee Nation announcement that we made earlier this week. And as a result of this business development activity and how encouraging it is, we've increased our recommended dividend 21% in dollar terms, and it's a highlight of our confidence in the business. Over to Lars on an update on Mozambique.
Right, so safety and well-being of our staff has always been priority in the company, so no less so this time. And despite the circumstance we faced in Palma, we managed to evacuate the majority of our staff in record time. As it is an ongoing operation, like Soraya said, we will not be able to comment on any specifics of that. As far as our camp and assets are concerned, these are protected by a security company and are untouched and insured. It is worth noting that the majority of the conflict took place in the center and north of Palma City, and our camp is located some 15 kilometers south of the city. Now, just prior to the attack, the weeks leading up to the attack, we were in discussion with our client for a 1-year extension on top of the 2 years already secured. This contract is obviously very valuable to us, and as the project is of significant importance internationally as well, as being the largest investment project ongoing in Africa at this time, we are confident that this will move forward in due course.
So just with respect to the financial highlights for the 2020 year, revenue was 64 million, about 8% down from 2019, which we feel was quite a strong performance given the operating environment, with COVID proving very difficult to continue with many construction projects starting in about March of last year. Underlying EBITDA was also 14.2 million, down from 16.3. Our EBITDA margin, underlying EBITDA margin, decreased from 23.5% in 2019 to 22%. Once again, a modest decrease given the fact that we were operating at around break-even gross margin on many of our construction projects during the year. From an operating cash flow perspective, we had very strong generation of operating cash at 21 million. That was due to some unwinding of working capital increases in 2019, but also just reflective of the fact that this is a very cash generative business, especially coming from IFM contracts. And net cash at the end of the year was 11 million, and gross cash was, I believe, 17.6 million. And as Soraya noted upon, we raised our dividend to 1.35 pence, which reflects our confidence in the business going forward. So this slide breaks down the revenue into our different service channels. As you can see, the integrated facilities management revenue is very resilient across periods of COVID, civil war, whatever other challenges are out there. These are primarily long-term, high-margin contracts, and for the most part, we're maintaining infrastructure for our clients, whether they're on-site or not. That represents 62% of our order book now being IFM contracts. From a construction perspective, this is where the decrease came as a result of COVID. At the time COVID kicked off and the health and safety concerns of our clients began to be addressed, we needed to suspend some of our work. And because of that, there was a deferral of revenue going into 2021. From a supply chain services perspective, we had $2.7 million of services specifically related to COVID works in 2020. But if you strip that out, 75% of the remaining revenue actually relates to long-term contracts, which are more reflective of the type of contracts we have in IFM than in your regular supply chain work. So these are reoccurring work that happens on a month-to-month basis, primarily delivering food to our customers in remote areas. So as shown in this slide, I think the big takeaway is the fact that we're funding our growth CapEx primarily from operating cash flows. So we had 21 million of operating cash flows again, and 24.5 million of capital expenditure. So the difference there was made up by a modest debt raise of 6.5 million. The cash conversion for the business does fluctuate year on year due to working capital increases when we mobilize new projects. So in 2019, we had a number of new projects that were kicking off at the end of the year. That led to a 66% cash conversion for the year. Obviously, last year being 291%, reflected much of the unwinding of those positions. So what we've done is we've looked at it over the last 3 years, and if you look at aggregate operating cash flows and operating profits, you come to a 121% cumulative cash generation figure. I think this is reflective of the business's cash generation. Another point that we've made in the earnings release is that we're anticipating 7 to 10 million of CapEx in 2021. So as I mentioned previously, we had 24.5 million in 2020. Most of that was related to the construction of the camp in Mozambique, and most of the 7 to 10 million is also to finalize that camp investment. But the free cash flow generation of the business is very strong in times that we're not, shelling out this money to build our own facilities.
On slide 13, our contract book is approaching $200 million, which is an increase of about 33% in value from 2019. We've added about $110 million in new contract wins, again in 2020, which is an uplift from the $91 million win in 2019 and $62 million win in 2018. The order book is weighted over 60% to IFM, which gives us the higher margins of the business. And our order book actually excludes any potential revenue from the Danakali announcement for the mine in Eritrea, as well as the Cherokee Nation project awards, the 2 project awards that we did. So this order book does not include those. The strong foundation of the order book is actually giving us sight going forward and establishing the long-term nature of the business and the long revenue that we can rely on as we increase this the order book. We'll now have a look at the encouraging work that we've been doing from a growth perspective that gives us amazing confidence to build on this momentum that we've been driving. The strategic execution. Now, when we came to market, we were looking at diversification, longer term contracts, unlocking value for the customers and following the customers. We have changed the business. We now have a very strong financial baseline for the business year on year with the order book. We're growing the business sustainably. We will be discussing our sustainability later on in this deck. And we are growing with our customers and unlocking the value through the customers' contracts through our long-term approach and the on-the-ground research that we have been doing. Now, in the last few years, we have been building our reputation with the customers, and we have been targeting mining companies from the early days, from initial scoping and exploration all the way through to the completion of the mine. The trust has been built, starting the relationship from the very early days and being able to convert them into projects such as supporting Danakali in the Kaluli mine in Eritrea with an expected contract value in excess of 20 million. We have also been in advanced stage discussions to secure a contract of similar value to Danakali with a new mining project in North Africa. I think our differentiation of having many years of ESG and sustainability has actually lent itself very well to the focus that mining companies are making these days on sustainable projects, and sustainability in remote sites is extremely difficult. Our track record of being able to do this simultaneously as operating commercial contracts in remote locations is actually set us apart from other players in this market. Now, it's worth noting that before we start any of these contracts, we would have had many years of research and many years discussing the projects with the client to enable us to be in a position where we're extremely comfortable with the execution of these projects. Earlier this year, myself and Bill Warnock, our head of US business development, were in the United States, and we were extremely busy with meetings with large US corporations, looking at establishing joint ventures and teaming agreements similar to the ones that we have currently with the Cherokee Nations. Just to give you a flavor of the way these contracts can develop, or these teaming agreements can develop, our initial foray with the Cherokee Nations was for a very small $2 million contract. We've now developed that over since 2019 to approximately 16 millions of contracted revenue. And we're working very closely with them in the sense that they are supporting the overseas building operations with RAI as the preferred supplier. Again, our differentiation here is that we can deliver these projects in remote. We can do it to very exacting standards as required by the US corporations for American projects, and we're able to provide turnkey support services to take care of ourselves on these projects, not requiring any subcontractor services at all. Now, these projects lend themselves to sole source, whereby the contracts are awarded on the person that is best suited to execute these projects. And within these teaming agreements, we are best positioned for the execution of these projects. Now, we've just been awarded, we spoke on earlier this week, the Cherokee Nations 2 projects that are not included in our backlog, and we anticipate a few more along the lines of these types of projects as we have been doing the joint ventures with our new US partners, targeting projects in the range of the $5 to $50 million in multiple countries.
Thank you. So operating sustainably has always been at the core of RAI International. We have been a signatory to the UN Global Compact since 2008, for instance. In 2018, we formalized our approach to sustainability, and we aligned our strategy to the UN Sustainable Development Goals. As this slide shows you, our focus areas are local skills development, which is SDG 4, labor rights, SDG 8, and resource management, SDG 7. Other areas where we have a positive impact or an indirect impact is our work on water waste and aligning our business with the Paris Agreement, which is SDGs 6, 12, and 13. Inclusion, in particular including women in our labor force, SDG 10, and supporting the growth of local SMEs, SDG 8. We got a lot of requests in 2020 how to align this with the ESG, or environmental, social, and governance, that the investors would like to see. And we began structuring this in 2020. In the slide, you can see how that fits in. Over the years, we've carried out community engagement initiatives in all our areas of operations. So we've made food donations to the leprosy community in South Sudan, supported widows in Afghanistan, and provided water and sanitation facilities to IDP camps following the 2017 drought in Somalia, for instance. These are all parts of the community outreach initiatives we do under the umbrella What We Can, Where We Are. Since we formalized our sustainability strategy in 2018, we have made substantial progress. So we've invested in our data capture, we carried out several successful pilot initiatives, and we've set ambitious targets. And in 2020, we took the big step to set our first science-based targets for Mogadishu. Now, Mogadishu, as many of you know, is our most established camp. And this will then set up a baseline for us and also create some lessons learned that we can then roll out to the other camps across the company. It's important to note that this switch to science-based targets is really an amazing step for the company because it aligns us with the Paris Agreement, which is very important for us. Now, obviously, all of this contributes to our purpose of delivering immediate results and lasting change.
So I quite like this slide because it highlights our transformation since the IPO in 2018, just how much the business has changed since then, and sort of how many of the goals we've already achieved. So when we came to market in 2018, the primary opportunities that we were bidding on were in between $1 to $10 million. One of the reasons that we came to market was to raise funds to give our clients confidence to place larger orders on us. And today, the bids that we're putting in are generally in between $10 to $100 million, with many of the awards that we're now winning in that size category as well. And if you look back at the last two awards we've put out values for, one was a $60 million award in Mozambique, and one is a 20 million plus award with Donna Kelly that will hopefully start this year. With reference to the order book, we now have $116 million of IFM within our order book that stood at about $187 million at the end of the year. We won $110 million of contracts last year, and bid activity has been fantastic both throughout the end of last year and into this year. So we haven't seen a slowdown in that regard, and we anticipate that order book to keep growing. With respect to the diversification of our customer base, that was another target that we had at the time of IPO to further move into the government and commercial sectors away from humanitarian. And now, as a percentage of our order book, government and commercial make up 52%. Our customers within those sectors as well, government and commercial, have the ability, in many cases, and unlike the United Nations and other NGOs, to place sole source awards on RAI International. Essentially, what that means is that if we are the only contractor that can meet their needs, either in terms of the geography where we're operating in or potentially the breadth of services that they require, they can place awards on our company without going through a competitive tender. Obviously, our price needs to be, at or around what their budget is, but we pride ourselves on being the best technical solution for the clients and also the best value for money, so that is never too much of an issue. And now more than 50% of our order book represents sole source awards. We're also now operating across 12 countries, or at least we were in 2020, versus the 8 that we were operating in 2018. So in terms of our outlook, I think if anybody's read the statements that we put out with our earnings reports, I'm sure you can understand it's a complex situation now. In terms of the long-term outlook of the business, we've never been so confident. As I mentioned, bid activity has increased, definitely not slowed, and I believe increased during the COVID time. The issue is simply that our clients can't get to sites to start to kick off these projects. So once the world opens up and global travel restrictions recede, we anticipate all of these new awards that have been made on us, and also hopefully upcoming awards to kick off and start generating significant revenue. We anticipate a step change in business activity once the world does open up, and hopefully that will be in the next 6 months. But if not, I think everyone's quite confident it will happen early next year. That's obviously measured in the short term by the events that have transpired in Mozambique over the last week. As per our announcement on Monday, we don't see any significant threat to the contract. We believe that revenue is simply just going to be deferred into future periods. That is quite a large development project, obviously, in Mozambique, and the client sponsor has repeatedly committed to undergoing that development.
In summary, like all businesses, we have been tested by COVID. We've adapted to the challenges and we've weathered the storm. And the numbers that we have announced highlight the resilience of this business. 2020 saw a step change in the business by the type of work we are winning, and you can see that in our growing order book. The level and nature of business that we are engaging with is also at a different level, with partnerships such as that of the Cherokee Nations and contracts coming up such as the Danakali Kaluli mine. This gives us real confidence in our ability to continue to keep growing the quality and size of our contracts and wins. Sustainability is becoming more and more important to our customers, and given our established track record in this area, it's an increasingly important differentiator for us. So to conclude, as we focus on the opportunities and strengthen and diversify our business, we continue to thank shareholders for their continued support. Thank you very much for listening, and I'll pass it back to Tamsin for Q&A.
We have a question which asks, can you explain the rationale for large amounts of CapEx recently, i.e. why the move from being a contractor for others to an owner of projects and having them on your balance sheet?
So RAI International has been investing in its own camp facilities and leasing these back to clients since before my time, and I started in the business in 2011. This is a model that had been rolled out in South Sudan and Somalia previously, and we'd earned good returns on it over the years. There's also periphery work that comes on top of this, and it also proves to our customers that we can offer them this integrated solution that we do sell. In Mozambique, we saw a place where that it was attractive for our investment in this type of facility. We were also talking to a number of different potential customers about leasing the facilities at the time that we made the investment, and we were validated quite quickly by being awarded the $60 million contract with our client who wanted to rent our facility on an exclusive basis for 2 years. So we feel as though the returns that are available through that type of investment justify the risk associated with it. And we also see this as not just a 2-year contract or a 2-year project. This is a long-term development which is taking place in northern Mozambique, and we see the investment as being justified by the return profile, not just over the 2 years, but in the long term.
And moving on, how portable are these camps? Does it have to be fully amortized by one client, and over what time period? Or can the assets be moved to another location for use by another client?
So it depends on the type of construction. In some locations, we're using prefabricated units. Sometimes it's a hard build, so be that brick or concrete structures. And there's various other construction methodologies that are used. We have permanent buildings, that are leased to clients on a 5-year plus basis. And in those cases, we don't anticipate that we're going to be moving those structures in the future. And we also have units whereby we lease to clients on a short-term basis and then relocate them after that initial term. We've been successful in doing that for some customers where we might set up a camp for them in one location that they require to occupy for a 6 to 12-month period, and then actually move those facilities to another location for them.
Thank you. Does COVID present any potential opportunities with governments and NGO organisations in Africa?
Last year, we did a lot of supply chain related COVID PPEs, which was brought in some decent revenues. And we continue to support the COVID logistics as and when these contracts become available. But I do believe that it'll take some time to come into the Africa space, just due to the limited amount of vaccines and the logistics around the vaccines within Europe and the United States.
Thank you. And following up from an earlier question, do you intend to build and own more camps?
If it's profitable and the client is going to give us a long-term contract, there's always a possibility. You have to remember that in these areas, especially where we were looking at earlier, there's a requirement for 25,000 bed spaces. RAI was looking at providing 2,000 of 25,000. So I believe that in certain areas where the scope is long and the demand outstrips the supply, specifically in this time by quite a large multiple, it is of interest to us. These camps give substantial revenues in IFM, not just the lease of the rooms. There's also the food, the water, the cleaning, the janitorial, the laundry, the internet services, the busing, the transportation, and all of these periphery services are actually within the higher revenue higher profitability of contracts. So they're very, very interesting and quite lucrative from our perspective.
Thank you. And Andrew, you mentioned potential acquisitions. What are you looking at?
So we're looking at primarily businesses with long-term high-value contracts in working in the same sector as we are, but potentially in different geographies. On top of that, we've looked at strategic acquisitions whereby we might acquire a license or a specific IP asset that would assist us in further selling to our customers or targeting very specialist work that some of our customers have.
Tremendous, thank you. And roughly what percentage of your business is in Africa? They're saying that they understand it's the bulk of your revenue.
It's primarily all of our revenue.
Thank you. Fantastic growth over the last 10 years. Do you think you'll need to access further capital to keep things growing and taking on larger contracts?
So the key reason that we need to access or would need to access further capital is if we have a number of large projects that would start at the same time. And that's always been the case. I mean, last year we had a modest debt raise in connection with accelerating the development in Mozambique. But primarily our need for capital comes from a number of large projects needing to be mobilized at once. And obviously that could happen if the world opens up and suddenly we have a flow of all of our clients wanting to get all of the projects at once. But luckily we're now an AIM-listed business and can hopefully tap the market for equity capital in that respect. But we also have a very strong balance sheet. And since we did the debt raise last year, received a number of inquiries if we'd be willing to take on further debt from some very high-profile lenders.
Thank you. And you stated that Mozambique assets are insured. Can you elaborate on the cover? Does it cover assets and loss of revenue?
It does. So we have business interruption insurance, both from a property perspective and from a political violence perspective. We also have quite a large, essentially we have a standard package of insurance we put in place for our overseas developments. And this would include property insurance, political violence insurance, insurance for our vehicles and heavy equipment, and a large number of policies related to our people and the risks associated with them and being in these remote areas as well.
Thank you. Are there any competitors on the horizon?
There are small local, should we say, businesses that do singular types of services on the ground, but they don't carry the relevant insurances that we do. They don't carry the quality control that we do. They don't have the network of supply chain, and they're not plugged into the international suppliers for goods and materials as per our clients' requirements. From a larger competition scale, you have companies that are focused only on catering. You have companies that are focused only on construction. You have companies that are only focused on a particular type of vehicle maintenance, a particular type of equipment maintenance. Where our differentiator is that we have a vertical that takes care of construction needs. We have a vertical that takes care of integrated facilities management services, which are things like your catering, your janitorial, your pest control. And we have a vertical of supply chain that underpins the entire business. Once you look at these three, for our clients, they can pick and choose the modules they require out of these different service verticals. So a client may require a construction job, and at the end of that construction job, they actually feel the need to do pest control and facilities maintenance of the buildings, and subsequent to that, they can also add on some catering and janitorial as they wish. This is a big differentiator for us, so we're not a single supplier company. So there are larger companies that I would call competitors in singular verticals, but at the same time, we don't feel that we compete because of the combination of services we provide. Within the larger space of government contracting, they tend to also subcontract RAI International for portions of work that they do not feel they're able to do, specifically in remote locations or in Africa spaces, in areas that they're not too comfortable. So if a global company got a construction contract, let's say for the MOD UK, a portion of that happened to be catering and facilities maintenance out in somewhere like Somalia, they would contract RAI International.
Thank you. And can you give us an understanding of capital allocation and your views on buying back shares or increasing dividends?
And essentially, we're looking to deploy capital into undertaking new projects. The second area we're looking into is potentially developing our own camp facilities if we see investment opportunities there. After that, we're looking at our dividend policy and to sort of act in line with what we've committed to the market of increasing dividends, as long as we can maintain adequate liquidity and cash reserves to both give our customers confidence and execute these large projects. And essentially, that's the thought process. The share buyback isn't necessarily something that we're looking to undertake on a regular basis. That was an opportunistic exercise that we went forward with, and one that reflected both the pricing of the shares at that time and our need to create, or at least the board's want to create a pool of shares to then distribute to staff.
Great, thank you. And are clients generally willing to pay higher margins because the product offering is much stronger and it's more efficient for the clients?
I'll just say that we offer very complex, so we offer services in very complex environments, and we feel as though we generally offer the best solution to our clients' needs. And given the globally significant nature of these projects, they're willing to pay for a quality job to be done.
I think it's also worth noting that these contracts are not decided on price to start with. The United Nations actually have a 60% pass criteria on your technical solution before actually adjudicating your financial offer. These are best value for the job adjudication. In some instances, we actually give the client options on different pricing, and it's up to them to choose the one that they want. And generally, they choose the one that delivers it faster, that delivers it within their time frame, and that delivers it with a potentially higher quality. If, for example, you want British standards in a remote location in Central Africa, it will cost more to get a British electrician in and have everything done to the standards required. So clients are willing to pay more because they know we deliver. They know that we deliver on budget. They know that we deliver on time. They know that we have never failed a client in the past from meeting their timetable and time frame. And if clients are working towards government set deadlines, their need to have the surety is far greater than their need to pinch pennies.
Thank you. And you mentioned that the events in Mozambique might reduce revenue by $10 million this year, but that you've got significant insurance cover. Will the insurance cover mean that the reduction in revenue this year will not impact your profits?
No, we have insurance cover in place, but it likely won't be applicable to the current situation with respect to contract revenues or profits. So no, that won't cover it. Essentially, what we were saying is that there's likely to be a deferral of up to $10 million of revenue to future periods based on the further delays that this event in Mozambique is likely to cause. As we indicated, we were negotiating a 1-year extension to the contract, essentially to allow it to be occupied at a much later date than what was originally laid out in the initial contract, and still for us to maintain a 2-year term.
Thank you. And can you give us examples of contract discipline where you've actively turned down work that's not profitable?
Just trying to think. Going back pre-IPO, we would definitely pick and choose our contracts according to profitability. If we had one in at 25%, 30%, and another in at 45, 50, and we could only afford to do one, it was obviously the higher margin. So we have always actively been quite picky on what we do, just as a direct result of not having enough cash when you're a small company growing. So we'd have to pick and choose what we would deploy our cash on. Since as the growth, should I say, developed, we have gotten even pickier to ensure that the projects we do embark upon are projects that we can deliver within the criteria of budget and timetable and do an amazing job on. And that's because of our reputation, and keeping that reputation means that clients come back time and time again. All our growth has been client-led. It's been clients taking us to new geographies, clients taking us to new types of projects, because they like the way we do business, and they like the different things that we bring to the table, from the sustainability, local employment, quality control, all the other things they can't find elsewhere. So we're very, very conscious of our reputation. We're very conscious on who our clients are, and we're very conscious on the margins that we like to achieve. And as you can see, even though we had a drop in revenue last year, we maintained the level of margins that we would like.
Thank you. And that's the end of questions. Soraya, do you have any closing remarks?
Thank you very much for your time today and listening to us give you an overview of how our 2020 year went. COVID is challenging. COVID continues to be challenging, but we're very confident on our outlook, as the presentation has shown you, with regards to the new business activity that we have been engaged in, from new bids to new clients and much larger teaming agreements. So we look forward to being able to see you all after the half-year results. And obviously, again, thank you very much for your support.